Hello traders, Gary Wagner here, approximately 12:30 in Honolulu, 6:30 in New York. It is Thursday, 22nd day of October 2020, and this is the Daily Report for Gold and Silver. Market sentiment seems to oscillate as headlines change. It is absolutely a headline-driven market. We saw that exaggerated in gold and silver pricing and the way they sold off overseas last night. That did affect our current trade. We will detail that when we pull up our technical studies, but first to the price board. Traders, we are recording this at 12 o'clock, which means that although current pricing on the screen reflects current trading activity, it reflects it in Australia with a different net change. That being said, gold is currently trading at $1906.90. It sold off to the tune of $23 on the day. Silver is currently trading at $24.83 . However, in New York today, it did lose a total of 41 cents, closing at $24.82.5. That, of course, affected our current trade in futures as well as Forex. We are still long our ETFs. We are looking at GLD, which gave up $1.77 per share and is currently fixed at $178.83. SLV gave up 33 cents or 1.42% per share and is currently fixed at $22.96. We were stopped out of our gold and silver trade. In terms of our gold trade, we got in at 26 and out at 07 for a drawdown of $19 per ounce or $1,900 per COMEX contract. It was exaggerated moves in Europe that really caused the market to trade with so much downside pressure before recovering so swiftly. We are looking at a 10-minute chart to illustrate that. We can see that when trading first began in Australia, we did have a decline, although it was a slight decline. It was Hong Kong here and then London, which began approximately here, that really resulted in the steepest climb, and gold trading below 1900 briefly before hitting New York, which is this price point here, and then beginning to recover, first trading back over 1900 and then trading to approximately 1906. It's currently at 1907.70. Traders, I take full responsibility for the stop being hit and subsequent losses that occurred, because I was under the assumption that if the fiscal resolution negotiations stalled, we could see a dramatic decline in pricing of the precious metals, and did not account for the exaggerated price swings and increased volatility that we have seen recently in gold. That being said, did we sustain any major chart damage, and what is our current outlook? And the best way to view our current outlook is to look at a daily chart. When we do that, we can see that although we had a dramatic sell-off in trading overseas, it affected the low of the market, but not so much the close, because we had a recovery as we moved back into New York. And the entire real body, even though it sold off to the tune of $23, remained at the bottom of this channel. I still believe that we will see a dramatic rise in gold, and depending on the outcome of the presidential elections, could see gold pricing hit 2,000 by the end of this year. And because of that potential, I remain extremely optimistic as to where gold could go through the end of this year. We did get a couple of questions from two subscribers today that I will address. The first one is from David W., and his question is in regards to a 24-hour market and how volume will have an effect on current pricing. His specific question is a market more volatile during high volume hours? And my experience after 35 years of trading commodity markets is it is low volume that will capture your attention, as large orders will have a much greater effect on price action during low volume, and therefore you tend to see a lot more volatility in the market during periods of low volume when large orders are placed. Our next set of questions comes from Chris P. He first says that last month, gold seems to have moved increasingly as if coupled with equity indexes, and we have seen this happen in major swings as people and institutions liquidate gold to cover equity losses. There are really two reasons when you will see them move in unison. And your assumption about liquidation of gold to cover losses in equity is a true observation. However, during those occurrences, the move down in gold is usually brief during the first couple of days of a sell-off. However, when you have the Federal Reserve implementing quantitative easing, that tends to be bullish for both gold as well as U.S. equities, and you'll see sustained periods in which both tend to move higher. That is currently what we're witnessing when we look at the overall trend of U.S. equities on the bottom and the overall trend of gold on the top. It is bullish for gold because Federal Reserve's quantitative easing program initially is printing more money, adding more liquidity to the monetary supply, and therefore inflationary, and devalues the dollar. It allows corporations to borrow money at next to nothing, and they utilize that money to make more money with that. And so it is also bullish for equities. I hope that answers your questions. This has been Gary Wagner, wishing you as always good trading. I am sorry I was unable to deliver that to you today. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.